Our last valuation was roughly 750 million.
Oh my God. Oh my gosh.
Yeah, not bad for a bootstrap company. I think it's possible to hit a 500 million ARR run rate by this time next year. I thought that we had a chance to do it. There's lots of great people we had in our bid, like MrBeast. Got nothing short of ambition. Now I want to go build the next $100 billion plus accounting software platform.
Okay, Jesse Tinsley, you have had the craziest 12 months of any entrepreneur that I have ever personally known. And you read about these stories, Rockefeller or Elon Musk, et cetera, but you don't actually get to know some of these people. So let me just recap. Since we last spoke, this company called Bench, which was an accounting firm, announced to its customers it was closing down on a Friday. By Monday morning, you had announced that you were buying Bench and you had had no prior conversations with them. Boom, already nuts. Then, the next week, you put together a group, including MrBeast, to buy TikTok. You didn't end up buying TikTok, but it was an incredible bid. Then you go on and you've bought several other acquisitions. At Cap, I think was the name of the company. You've rebranded to Main Street. Dude, you have probably a more than billion, probably approaching a couple $1 billion enterprise value company that you've built kind of out of nowhere. You've made yourself a billionaire, not through inventing Facebook, and that's my words. How are you doing it, man?
Generally, if you have big ambitions and you can actually have a track record of producing operational efficiencies and closing on deals, people tend to want to back you. I've actually, I'm joking recently, it's easier to go raise $100 million than it is to raise five. I'd much rather go raise the 100 because there's a lot more larger check sizes, whereas five, you might have to cobble it together through 25 investors. You might raise the whole 100 from one person. It's a different scale and scope, and the audience is very different. So I think, I think TikTok's a very unique asset. I think also too, right? That's one of the most popular social media company in the world at the time, and I don't think that's a hard one to raise on. So I'll take some credit away from myself, but it was fun. It was a really fun process. The group that ended up getting it is obviously world class with Susquehanna and A16Z and Silver Lake and all of them. So
how did you even get in the room? No offense to you, but most people outside of maybe your small circle know who Jesse Tinsley is, right? They know who Oracle is, or they know who Microsoft is, but then all of a sudden this guy, Jesse Tinsley, comes out of nowhere. He's leading a group that has a real $20+ billion bid to buy TikTok. How did you even get in the room?
Generally, there's a flywheel effect of momentum, right? Once you get certain things in process, more people want to join, right? And so we're obviously really fortunate enough to have worked with some great folks like Jimmy and his team and David Baszucki, the CEO of Roblox, and folks like that. They're just, and Nathan McCauley from Anchorage, and just really amazing folks, which is a lot of fun. So I think the more momentum you have, it's just things kind of fall into place. Lots of synchronicities, I'd say. So, but it's a lot of fun.
Well, let's go back. In the fall, you bought employer.com. and transition there. And then Christmas time rolls around and everybody on Twitter was kind of running around with their hair on fire.
Yeah.
Because bench accounting shut down. They were done. They announced to all their customers on a Friday, they're like, sorry, we can't service you anymore. They were going out of business. And you didn't have an inside line on Bench, right? You weren't already talking to them?
Yeah, just take one step back actually from that. So what happened when I originally started my first business, it was a services business. And my co-founders, David and Ben, and I got together towards the end of last year and basically founded what was going to eventually become employer.com. So we didn't actually kick off that, start that business, which acquired my first company and acquired Bench and acquired all these subsequent businesses and started to grow pretty massively until about October, November of last year. So that's when we really went all in on what's now rebranded as Main Street, and then obviously led to the acquisition of Bench and all of the subsequent brands. So the business has basically only existed about a year, just to put it in context, first off.
Insane.
And this is kind of a very interesting story on the Bench side. I think it was the weekend between Christmas and New Year's. And so it was the most dead weekend probably exists in business, at least in North America. So it basically was, I didn't even see the news till Saturday, and I was on the East Coast. And so I woke up and I had a few messages from folks. And what was interesting is I'd actually talked to our CTO, Ben, about we needed some general ledger, accounting tracking software, either through a partnership or building it ourselves. And I was like, wow, this is really fortuitous timing because seems like we could probably buy this business that does the exact thing that we need to integrate with our other systems. And so I reached out to a mutual connection that kept me with the board. And those conversations evolved, very, very quickly. Yeah, things kind of took off from there. Happy to dive more into the story, but that's the.
And you just reached out on LinkedIn, right? You reached out to somebody on LinkedIn who was kind of a mutual, and then they put you in touch with the board.
Yeah, exactly. Yeah. One of their
You freaking executives.
Yeah. I was like, he kept me with the board of directors, and yeah.
So how big was Bench, right? Because they were VC backed. They were a tech platform that all of a sudden just said, no, we're out of business. How many customers did they have? Do you know how much ARR they had at the time where they said they were going out of business?
It was like very healthy business, very unfortunate circumstances, obviously, for many people. But I think roughly looking like, I think it's like 11,000 customers and 40 million ARR, something like that. And I think according to like some of the like articles that have been released, apparently we paid $9 million in cash for it. So
how big was your company? So I'm just going to call it Main Street just for simplicity's sake. I know it's kind of a lot changing, but at the time, Main Street, if you were to compare 40 million ARR with Bench to Main Street, what was Main Street doing?
Not that. As much, not really as much. We were doing we just started 20. Yeah.
10.
We had just, okay. So like other than rolling in, like we were in the process of acquiring a few other companies, and we were probably right around, 1/4 or 1/5 the size of the company. Like something smaller, it was much smaller, a lot of ARR basis at least.
So like way smaller. My first question to you was, I remember us talking about it, was like, how? Like this Bench is way bigger. It's a distressed asset, and it's not necessarily something that was in your core competency. So like to me, it's mind blowing. Like how did you even A, figure out a way to buy it, and then B, figure out a way to actually integrate and onboard a company of that size with 11,000 customers?
First off, I would say we had a broader vision prior to this of like a full end-to-end like S&P like back office automation, which included like originally the idea stemmed from like going after like the payroll like EOR space, but that was like less appealing as we dove more and more into it. Mainly because there's just a lot of competitors that are really great at like Deal, who we just did this deal with for Capbase and Gusto, and there's Rippling and Workday and Paylocity and Paychex, where the list goes on. There's tons.
Bamboo HR.
Yeah, exactly. So everyone can name a new one on top of that.
Yeah.
There's good payroll providers, but there's not very many accounting like software companies. There's really, if you looked at the top ones, you're looking into it, Xero, FreshBooks, Main Street, and maybe like NetSuite on the enterprise side, or Wave. Like those are really the only big ones that have a lot of scale and scope. Everything else is much, much smaller. So if you compare that to other sectors for like back office S&Ps, like we thought that was a really, really big opportunity. So when this came up, we were all hands on deck. And we kind of built our operating model where like our CTO and COO could plug in and actually run companies day one. And we proved that thesis out in a very short 36 hours that weekend.
When you were telling me the story, it reminded me of, there's a famous story of Elon over Thanksgiving, they're flying, and he's asking how long it would take for them to actually move their server center in Sacramento. And one of the members of the team was like, weeks. And Elon's getting like more and more irritated because they're telling him a timeline that he doesn't want to hear. And so he's like, screw it, let's go to Sacramento right now. And so they turn around midair, they go to Sacramento, they land, and Elon's there with like a freaking knife. He lets the security guard lets him in, and they like move racks that weekend. That story reminded me of this Bench story because it's a bigger company. And in one weekend, they went from we're going out of business to then sending an announcement Sunday night or Monday, I can't remember. Hey, actually, employer.com is going to be servicing you from now on, and you're not actually going to lose access. Congratulations, you're still going to have ongoing support. It was mind blowing, but the thing that is the most mind blowing is that your customer, I guess, satisfaction has not gone down. Like, how has the experience been of Bench customers that have transitioned to working with you?
Yeah, I think like all things, we're always like striving to improve and like make it better and better. I think part of that with too is just our NPS obviously has gone up. I think churn's gone down quite substantially.
Can you say that one more time? Sorry, it's NPS. What does that mean?
Net promoter score. So like how your users and customers would give you feedback based on what their overall sentiment is. And so that's been like a great, I think, turnaround story. We've actually taken the business from, I think they lost like 40 million roughly on a P&L basis, like in 2024 to, positive cash flow, free cash flow, positive, but also like an EBIT of like somewhere between 12 and 15 million just on that business alone.
What?
That's like roughly a $50+ million swing with less people, and also like really, really high increased like efficiency and better like outcomes for customers. And we're obviously still working on improving that, but I think part of that's like a mindset shift, and I can tell an interesting story. Like even I think it was like week 1 of owning Bench, but we've been driving a lot of efficiency.
What's the week 1 of owning Bench?
So there was a situation where like obviously like we were in this sprint to get Bench up and running. I basically told the board that we weren't interested. It basically went into Monday because we knew that it's like a melting ice cube in the summer sun.
Yeah.
Right? Just all your customers are gone because every competitor in the world is reaching out to run email campaigns on running Bench, searching Bench, login, anything like that, right? So you have tons of churn if you don't start to fix this before business starts. So long story short, our team sprinted through it, got a docs done, and we got like the servers online some point, Monday morning Eastern at like 4 or 5 in the morning, something like that, which is amazing. We had 100% uptime from there, which was really, really great turnaround. And then I think like part of that, like similar to like the Elon story, right? And Elon, I don't know that I've heard that story before. And we worked with Twitter, and he was doing that turnaround too. So I've seen how he's like operated very direct, like very direct, like from, 1 or 2 layers removed, but nonetheless, like he obviously moves with sense of urgency and does things that are probably unorthodox to others. But similarly, week 1, we basically had, I wanted to figure out what the customer experience was. I think it's like Tuesday or Wednesday of the following week. And I basically submitted a form, like basically, customer service request, and saw what the response was. I just kind of going through that workflow to see what it was like. And it's like, hey, sorry, because whatever, we're going to get back to everyone in like 7 days. And so I immediately called up the VP of customer success and said, hey, you're going to change this. You're going to do it. And you're going to say, it's going to say in the next 24 hours. And they're like, that's impossible. And I said, no, it's not. I don't care like who has to answer tickets, like get everybody up on all teams, whether it's engineers or whatever. I don't care. Like, just keep in mind, like they had laid everybody off on Friday. This is Tuesday. So we had to rehire everybody Monday and to onboard people compliantly, with all the different bureaucracy that goes with that. And then fix the customer issues once we've onboarded, ran people up into new systems, right? So it's not like as simple as just turning things back on. We have to go sign up for I think every customer basically submitted 1 or 2 tickets, or like 10,000 customer tickets in that time frame, give or take. And we got through all of them, not in 24 hours. So maybe our VP of customer success was right. It's probably impossible, but we got it done in like 26 or 7 hours, and which was, again,
oh my gosh,
further, like way faster than it ever would have been, in previous, leadership. I think because there's both in the drive for urgency. So.
Do you think that was necessary to kind of set the tone with that team of like, hey, there's a change here, right? Like not only is Bench gone, because like you said, they got laid off, and then all the customers were told they're going to lose access. Then they had to go through this whole rigmarole. They're re-onboarded, like you said, new systems.
Yeah.
But that, like sticking your flag in the ground, was it as important for you that the customers be answered as it was sending a message to the team, or is it only in retrospect that you realize?
Yeah, that wasn't so much like sending a message to the team. That wasn't like the objective. I think like generally what I share with our team is, like if I had to stack rank, and my team probably would not like this, but like a stack rank like customers above team, because if we take care of our customers by proxy, I can take care of my team, right? And keep them employed. And like we've been very historically good and not like having layoffs or having issues because we run profitably, right? So it's very like it's a kind of a self-fulfilling cycle where you take care of your customers and do well for them, have high like NPS and good like customer satisfaction. You're basically going to be able to take care of your team at a very high level. And so that's like the priority, right? We wanted to make sure in order to maintain a profitable and like growing business with Bench, that we took care of our customers so that, they're staying and, obviously becoming net positive customers and referring their friends and whoever to Bench as well, long term. So
to go from losing 40 to making 10 to 15, a $50 million swing, like that's not just, we came in and realized some operational inefficiencies. There's definitely a cultural and a mindset shift in there as well. So yeah, I don't know, that story just kind of resonates.
Yeah, definitely. I think like even at scale now, if we continue to grow, like kind of the same operational like mindset. We're free cash flow positive. We'll operate heavily like probably in the black. We reinvest a lot in like go-to-market and R&D, but for the most part, focused on maintaining at least like break even.
I get that buying Bench made sense from a strategy standpoint, because you were like, hey, we looked around, we realized we didn't want to play in the payroll space, but we really like the accounting space. Bench comes up, we got to move quickly and take advantage of it. But they were a company that was 5 times your size, $40 million in ARR, and distressed. How did you pull off the financing of the deal? And then probably the thing I'm more interested in is, how did you pull off the freaking integration? It's just really hard to integrate companies.
Yeah, definitely kudos to my co-founders and our team. They spent a lot of time on their integration piece and everything else. I think in terms of financing and everything else, there's many ways. We get pretty creative, like how we do deals. We generally don't lever a lot of debt, and we use free cash flow or other means to basically to buy companies. So I think generally it's a question like balance sheet item. It's a balance sheet item question. Like we use free cash flow, debt, and obviously equity in most cases. But yeah, so that's the context.
For you, it was just getting really creative with Bench. It was like, hey, this is kind of the combination that we can do. It wasn't necessarily, here's a blank check, I'm rolling in.
Yeah, obviously, I think that like it's tough. It's very tough to fully diligence a business over a weekend, and you're trying to get all into key details and full diligence and make sure you're not going to have all sorts of like unmitigated risk. So it was a very unique situation. I'd say like all in all, that one is an outlier compared to everything else we normally do in terms of like, we actually, just for context, like we usually don't even bid on deals that are distressed as a rule of thumb. And separately, like we won't bid on competitive bids. So like recently there was who was it? It was the Monster and Career Builder bankruptcies. And that was like one deal. And they had a ton of ARR. I think it was like, well, I'm not sure, but I think it's fine to say they had a lot of ARR, very, very cheap comparative multiple, right? Like of ARR, like if you just bought it and just cash flowed the business, you'd make a killing.
Okay.
And so, but because we're known in the space for like doing like acquisitions in a very short time frame, we had three different parties approach us to join their bid. Like, hey, do you guys want to put in like 20, 30 million on this? This is like right up your alley, right? It fits in your brand portfolio of Main Street, employer.com, recruiter.com, right? And we passed on it because we actually we get lots of proprietary deal flow, not because it wasn't a good investment. We thought it was a really great investment just from a pure like cash flow perspective. But we didn't actually want to do it because we didn't want to have conflicts with deal sourcing. Similar like Berkshire, like Warren Buffett's been pretty like similar model to him, right? Over the years, he won't jump into processes that are highly competitive because he doesn't want to burn bridges over winning one deal, right? So I think playing the long game there has benefited us a lot, and also built a lot of loyalty with folks that have rolled equity in our deals, like Greylock and Signal Fire and some other VCs. We've done, I think, really well and outperformed what the expectations were. So I think like that also helps build goodwill, and that's one of the reasons we actually got Bench. So it does tie back into what we were talking about. One of the investors at Bench, I think, was traveling at the time, and this had all happened on Saturday, and they were like on a plane flight internationally somewhere for a trip they already had planned. I think I talked to him like 2 a.m. Eastern, like Sunday morning. And he's basically like similar question to you, like, who are you? Right. Like, what? So I was like, it's good to meet you too. And long story short, though, he actually had his first company he had done back like 20 years ago was angel invested by one of our lead investors or like large shareholders from Greylock. And long story short, that instantly gave us credibility. I'm like, yeah, you can just back channel, XYZ person. Like that's our GP there, like talk to them. And anyways, point being is playing that long-term game really helps, right? Because like, that's actually how we bought Main Street and others is, we have VCs like, hey, we have this company. We'd love to plug them into you. We'd love to roll equity, right? And that helps kind of build that flywheel effect.
Hey, I don't know if you remember this, but when we started this podcast, we entered into a social contract. I would spend time, energy, and money producing this podcast, interviewing these individuals and giving you insights into how to build, buy, start, grow your business. And you would like, subscribe, and leave me 5-star review. Now, out of that, we both get to talk to really cool people and hear really cool insights. We both get a ton of value. But I just want to help you keep your word. So would you do me a favor? Will you go leave a 5-star review for me on Apple or Spotify? It would really help. And if you want, even share this with a friend. Can you tell me how Bench is doing? So it was 40 million ARR when you got it. What's it doing today?
That's doing really well. I think we're like collectively across the entire business, we're projecting to have over 200% growth across all things, which would include Bench, obviously, for the year. So,
well, just putting Bench in perspective, let's say $10 million of free cash flow, and let's assign a 10x multiple, which I think is fairly conservative. You turned Bench into $100 million asset in less than a year. I mean, I know you can't say like exactly what is value. I'm just doing back of the envelope now.
I actually tell you our latest valuation. Our last valuation was we did it on a deal. We're roughly, I think, valued at right around, paraphrasing, not exact numbers, but roughly 750 million.
Oh my god! Oh my gosh! That's across everything, or that's just Bench?
That's across everything. Across all things. Oh not bad for a bootstrap company.
It's insane. It's insane. A year ago we talked and like your company was $20-30 million from what I remember, right? I could be off a little bit, but in a year's time, 20 to 750. And it's not like you invented Uber. Like you just went out and bought good assets at discount prices.
Yeah. And I think we'll be closer to about, in the next few months, I think likely surpass like well into the 10 figures range. So I think we'll be $1 billion plus in the next.
You're so stupid. That is, dude, it's ridiculous. That's ridiculous. So, okay. You do Bench is turned. It's incredible, but it was in and of itself a crazy story. And then we were texting and you were like, ha, TikTok's next. I'm like, oh, what the freak?
I was probably more joking when I texted you that.
Serious. Well, I don't know, man. You put it out to the universe, and the universe was like, Jesse Tinsley, you deserve TikTok, young man. And like, all of a sudden, it was happening. Like, I can kind of understand going from, hey, we got a $20 million business, and we just got this $40 million ARR business. It was a stretch, but we figured it out. We got some, I don't know, maybe we got some financing together, but we have the team. We did the transition. But then from that to TikTok, like one of the biggest apps in the world, a multi-billion-dollar asset that's being divested from the Chinese government, and you are in the same breath as, like I said, Microsoft and Oracle. How, Jesse? Like it doesn't. My tiny brain does not comprehend how that happened.
My tiny brain feels the same way a lot of days. It's different when you're like in a flow state, right? You're like a flow state with certain things, and it seems like how did I end up like buying this company? Like it just seems like things happen, right? But it's all like the micro interactions throughout the day. Everything compounds, right? And I'm if you looked at my calendar in like general like calls and texts throughout a day, like I'm talking to 50, 60 people, they're that compounds into those deals like taking place. And I think that it's hard to look back and actually have like kind of introspection on like how things are happening. But I think that I'm really good at like seeing where the future is and how to like work backwards from the end result. So if I want to go, let's say something extreme, like the New York Yankees, right? I would go and build a plan around, okay, these are the owners. How do I get engaged with the owners and then build everything back from there? I don't think, honestly, it's something the New York Yankees would love to buy them. But
I wouldn't put it past you, but okay.
Has to have a willing seller. I wouldn't be a willing seller. But nonetheless, that's something I'm really good at. Like competitive chess growing up and other things. And like I can see and connect dots from, oftentimes my team will be like confused, like, hey, how did you get from this result to this result? I'm probably missing the middle context, and I can go from A to Z. And then,
give me some of the middle context for TikTok. Like, was there a person or a conversation that really set it in motion, where it was like, oh, once I talked to this fund, or once I talked to MrBeast, or whoever it was, where then it kind of became its own self-sustaining thing with the flywheel in effect? Was there a single conversation like that, or situation?
There was a single conversation, obviously. No. There's lots of great people we had in our bid, like MrBeast, but I think that there was no one like inflection point that stood out more than the rest. I think that every conversation led to a half dozen new conversations. So it was pretty wild, right? I think, that was a pretty ambitious bid, obviously, for all intents and purposes, and got nothing short of ambition. Now I want to go build the next, $100 billion plus accounting software like platform. It's kind of my goal right now.
Let me ask you this. Did you feel like I'm not going to get TikTok, but this is going to be really good for me because I'm going to meet all these people. It's going to be good name recognition. the secondary and tertiary effects of this situation is just going to be good for me? Or were you like, I'm freaking buying TikTok and you were pissed when you didn't get it, or somewhere in between?
I thought that we had a chance to get to TikTok like that. So that was like my main goal, is on winning that. Now I'd say like, I didn't really, a lot of people thought I was doing it for a publicity stunt. I really didn't care. And I actually prefer to be pretty, if you see how many like podcasts and everything else do, I'm pretty like incognito generally as a general strategy. I don't want to self-promote for the sake of self-promoting. Like if there's something to talk about, I'll talk about it. But otherwise, that's not my MO, honestly. So, but that said, I think like obviously it's had those effects and met some amazing folks, like the ones I mentioned earlier, but a ton of others that were in that bid that I have a ton of respect for and will be doing lots of business with over the coming years, hopefully. And it was definitely not a bad outcome. I think, yeah, I've just met some amazing people and happy that they came up with a solution that actually works well for everybody involved. And like you said, they've got some great backers in that bid.
So the rest of the year has been a blur. You've done multiple acquisitions since then. You're rounding out this thesis that you kind of created a year ago. Here's my question though, because I think sometimes an entrepreneur might listen to this and be like, oh, that's TikTok. I'm not buying TikTok, which is true. Only Jesse Tinsley and two other people are like in the conversation for buying TikTok. But the thing that I'm like most interested in and really impressed with is acquisition-led growth is really hard. Obviously, organic growth is hard, but acquisition-led growth is really hard because you're buying other assets that already have a culture and an ethos. Like there's already just momentum going with the way that they're operating. And you've got to bring them in and change habits and reorient them and onboard. And it's a lot. So when you're sitting here telling me $20 million last year, kind of a year and a half ago, ARR to a $750 million valuation this year, or maybe it's ARR, I can't remember, but 750 is the number.
750 ARR would be amazing. It would be worth like 10 million.
Okay. Valuation still. Like, how did you onboard that? I don't think people understand how hard it is to successfully onboard and integrate. What are you doing, man? Like, how do you do it?
There's a few things. We built around like first principles. We'll generally get like alignment, like because cultural, the point is, to your point, the most difficult part is the people, right? So like culture, assimilation, expectations. For larger acquisitions, we'll generally let that business be a standalone, and then we'll have alignment from leadership top down and let that run somewhat independently, but then build the products into one platform. So that's the first thing, is like looking at the cultural alignment. We'll pass on deals if they're too misaligned, because that's obviously going to cause a lot more issues and friction over the long term. It's just not worth it.
Have you passed on deals? I can't believe you've actually passed on a deal. Have you actually said no to deals?
Hundreds of deals. Yeah. Like so many deals that you've no idea. Yeah. We see stuff from like, biotech and med device, all like just things that are completely out of left field, right? We obviously pass on. Just, okay. I couldn't value that business if I tried, even if you were giving it to me for free. Like I don't have no idea how to run it or do it.
So step one, you stick with your buy box.
Yeah, exactly. And there's a certain scale and scope we go for now. I think that's why I posted actually something went viral a few months ago. I was like, hey, I have a few businesses, but like they just want to like roll equity and like get an earn out or something. And they have like 100, million ARR, right? Like there's tons of business like that. If I wanted to go, if I was actually an entrepreneur, best advice I could get to your audience if they're entrepreneurs, like I would go and I would try to do like, if I was starting from zero right now, I would go get like I would go be, what do they call it? I don't even know the name because I don't just study this stuff, but what's it called? A search fund. I'd start a search fund. And I get a few backers and say, hey, if I get this type of profile business, you'll back me and help spin up like working capital, right? And I would go and I would figure out the niche that I feel like I could add impact to. And I would go and I would not build, I would buy a few different companies and put them together. And I think you could do a much smaller version of what we've done, but get to 5-10 million ARR and then scale it from there, or sell it and make a decent amount of money. Make a few $1 million in a year, I think, which is not
really.
That's it's free advice, no course, no content to sell. So I honestly think if I had more time, I could do that all day, every day.
Is it just because you're seeing how many deals there are at that size that you're like, I'm not doing these deals. They're too small for me, but man.
Yeah, there's nothing that happens with them, right? And they're subscale, right? So like, if you look at the markets right now, like there's like a dead zone between like Series A and Series E. And even from like seed to Series A, right? There's like this huge drop off in funding. So you have a lot of companies with raised that are running out of money that and the founders are burnt out or tired or want to leave, right? And so there's lots of little businesses that they're micro SaaS that just have no outcome that's tangible.
Just to clarify on that, you said Series A to Series E, like just so other entrepreneurs understand, when you're saying Series A, by the time you're raising Series A, you've got a product for the most part. You've got like something that's
high scale revenue. Yeah.
Yes. And so what you're saying is like, don't worry about the angel rounds or the seed rounds or any of that stuff. But there are companies who have actually raised real money. They've got a real viable product that are kind of in no man's land. Series E is maybe gap funding before they go public, or so the last round. Is that kind of fair?
Stage, yeah, growth rounds and stuff. Yeah. So there are a lot of pre-seed and seed companies that like kind of fall in this no man's land where they can't raise additional capital. This creates an opportunity, right? Because they can't exit, right? There's no one unless I don't know, like unless it's a strategic buyer, which most companies haven't been buying the last few years, and you're too small for private equity. Really, the only kind of thing that falls in there is like a search fund of sorts. And so there's like a misalignment in the market, like a market inefficiency. And I think you can make a lot of money doing that, right? That's what I've told my friends. My friends, they come to me for advice. I'm like, I would go start a search fund. I'll put money in myself. I'll put if anyone smart listeners like that are entrepreneurs that have like either operational background in tech or like computer science, and they want to start a search fund and go after some stuff, I'd love to talk to them. So there's a huge opportunity there. Obviously, it's a bit messy and like things can go wrong, but even if you just ran it on like a cash flow basis and started returning capital to investors, I think like you could make quite a significant amount of money.
Where would you find those deals? Asking for a friend.
I think they're out there. I think like you can look at like there's different like funding sources you can look, or you can ask an LLM. They'll like tell you if you want like create like a research list of like companies that raised like seed or pre-seed stage fund, like how much they've raised in these different sectors. It can create a whole like Excel spreadsheet.
Okay, so you would start with, hey, where would I want to focus? Like, so for me, I know healthcare. I know this particular space. Cool. Now I'm going to create a research document with all the healthcare companies in that space that have raised money, and then just cold outreach or like see who I know that knows somebody.
Yeah, I think that's probably the first thing. I get a lot of proprietary deal flow through like social media and just brand awareness, as well as obviously now it's much more complex than that. We have lots of different referrers, whether it be like investment banks or other founders or VCs, private equity, et cetera. So the starting point for like anybody would just be just doing some research and then reaching out to different founders or folks that are doing a lot of acquisitions like myself. That are just like, hey, oh yeah, you want a connection? Like I can think of like a few companies today that like are doing, 300, 400, 500,000 that like reached out to me in the last week that just way too small for us. Like we don't have time to focus.
Yeah, I could be like, hey Jesse, just give me your sawdust, man. Like you're never going to do those companies. Like just shoot me. You know what I mean? Like that
saw gold
could be
it's like sawing a gold.
Saw gold.
Yeah,
Saw gold. That's awesome. Well, like the interesting thing about those companies, I was talking to somebody, I do these office hours for a company called the Acquisition Lab, and someone came with a deal and they're like, hey, it's a SaaS product and it's doing about $2 million in top line, $1.5 million in bottom line. It's been flat, if not declining a little bit in revenue. I think I should maybe value it at 10x.
I lost track. What was the numbers?
I think like ballpark, it was like 2 million top line, 1.5 bottom line.
Okay.
Wasn't growing, if not kind of declining a little bit in top line revenue. And this person was like, I think we should value it at 10x EBITDA. And I was like, that's a valuation for a tech company. This is not a tech company. This is a small business that happens to have a tech component to it, because there are some of these that they're not going to turn into a unicorn. They have a very specific use case. They're a cool niche solution, but you don't need to value them as a unicorn. Value them as the small business that they are. And there's nothing wrong with that. They're spitting off cash flow. They've got a little bit of a moat. Great. That's why I like kind of this method is a normal entrepreneur could come and just find one of these businesses. And if they understand how to unlock the value and run it like a small business, they can create a lot of value. If they might get into trouble if they start thinking, oh, this is going to be the next unicorn. And then you justify throwing a lot of good money after bad.
I think that like the best advice I give founders that ask me for advice, like build like whatever. If you want to build something, build it around what you value, right? So if you want to go build, like for me, I like scale and scope and like just bigger and bigger like opportunities and be able to help like all like as many people as possible, like run their back office more efficiently. I think it's kind of my goal, but like that's might not be the goal for most people right now. I could turn around and sell my business and never work again, right? Like, I don't even have to sell my business. I don't have like it's the choice, right? So I think a lot of people, if you want work-life balance or focus on your family or focus on your parents or your health or whatever, I think that like this is more that work-life balance and like lifestyle business that you could do with those small like SME like SaaS companies with a few of them, different sectors. And I think with AI and everything else, I think you can start to automate a lot of those efficiencies where, customer success, running your back office with Main Street first off, and then like running and using like Intercom, like, or some similar competitor like Burst DS, like their AI solutions are great, like reduce tickets like 50+%, right? And so stuff like that, you start to have huge like cost reductions and savings. And I think you could cash flow those businesses out over 2, 3, 4 years and make quite a bit of money.
How do you view what you're doing? Do you view it as venture capital? Do you view it as private equity? Do you view it as value investing? Like, how do you?
None of the above. I value it.
Okay.
I view it as like an entrepreneur. So like, I think I want to build like an S&D platform of scale, number one globally for automating the back office. And that is a technology company. I think that people oftentimes will think that it's like private equity or like, or all this other stuff. But there's fundamentally a mismatch in like price valuations of SaaS companies right now compared to historical norms. And I think because of AI, valuation swung too far in one direction where I can buy companies for, 2 years free cash flow, essentially at scale, like, we're talking 25+ million ARR businesses I can buy. For example, I'll give you like just a math example. Like I can buy a $25 million ARR business for 1x cash and 3 or 4x equity. And then on the flip side, because we're now into the like,
sorry, what does that mean? 1x cash or 3x?
So 25 million cash, let's say. Right. So we'll pay 25 million cash. We'll pay maybe 2 or 3x, basically like, let's say 4 times total ARR. So 100 million, but we'll give 75 million in equity. But on the flip side, there's arbitrage because we're probably trading much higher. We're trading at like closer to 10+ times ARR. And so there's immediate arbitrage there that like is not seen. And obviously those companies don't have that impact by themselves. So they're standalone, but when you plug it into a platform, that's a very, very different equation.
Well, that's like the private equity piece, right? Like private equity roll-ups, they're able to realize those values because there's an arbitrage there. But at the same time, you're not just private equity, you're focused on tech. And you're going to have to build custom and proprietary tech to get these systems to integrate and operate.
I'll tell you, like we're actually like one of the coolest products. We haven't launched this publicly yet, so I'll talk about it anyways. Like you saw like a few months ago it was working at like multiple full-time jobs. I forget his name, but 7, 8 full-time jobs. We've been working on this product. This basically falls into our solutions with like background checks and like identity management, where we basically can with 100% accuracy detect employment fraud. So if you have an engineer or any other employee that's working a full-time job somewhere else, we 100% know that with like absolute clarity that they are, defrauding basically their employer, which has no statute of limitations in the US. And I think what's really cool about that, like, is actually, that's the biggest cost for these businesses of like, if you're a startup and you've only raised $1 million, you have an engineer that's working a different full-time job, like that's a huge, like some cost, especially if they're not performing. I think for like me as an entrepreneur, I have no problem somebody's working multiple full-time jobs if they're a top performer. Like, great. Like I would probably try to figure out a way to like incentivize them even more to just spend more time with us. How to like pay more, like salary-based equity bonus. What is it that can make you work here full-time? That would be my first choice, right? Like, and if not, we just let them do what they do. But if you're like a bottom percentile and you're just dragging down everybody else, right? The concern is not so much them in isolation. It's everybody else they're impacting by just, sandbagging work and right, or just being a low performer working 8 other jobs or whatever they're doing. So that's something like we proprietarily built that doesn't exist in the marketplace. That it's pretty cool, and that has like by itself could be a massive. We have some very, very large like Fortune 500 customers onboarding for that.
How many employees does Main Street have?
Roughly 300 plus.
And how many of those employees are like part of the management team? Like how big is your leadership team?
It depends how you kind of, but it's like probably 10, give or take, on like the C-suite side.
Has that been a weird transition over the last year to like go from where you were to now a team of 300 and a robust C-suite?
We'll be closer to about 600 by January, so that'll be a fun transition. But nonetheless, I'm somewhat like, I think the biggest thing, I think seeing like Jack Dorsey and Elon and others talk about this, like it's hard, like I put like reminders in my calendar and try to connect with like early employees that might be like further removed from what's happening top down, like on a monthly basis or bi-weekly basis, that they're not like, because, they might be 10, multiple levels removed from myself. So they might just not talk and so that's always weird with a scaling startup. So I think that's like the biggest thing that I try to like lean in on. But other than that, like my day-to-day is actually relatively easier because I'm working on higher level, like less problems and higher level problems, right? So I might have 2 things that I do this week that are like mission critical. And if I get those 2 right, business is, 10% better immediately, right? From a valuation perspective. So, yeah.
Do you have an office? Like, are people in the office, or is it your team 100% co-located, remote?
We're completely remote, but we're actually opening new offices early next year. So we'll have one in the Bay Area and then one in the East Coast as well.
So 12 months from now, you're currently, you went from 20 million to 750 million, let's say enterprise value in 12 months. 12 months from now, when we talk again, what is Main Street going to look like? What's the blueprint over the next year?
I would optimistically say that we'll be worth, at a fair multiple like value. Like I think my goal would be to be worth at least 5 billion, probably with 500 million ARR.
Stupid.
I think it's clear line is 500 million ARR on the next year. And it's not like just saying that, but I think both inorganically and organically, because again, the flywheel effect is just so strong as you start to have like very high NRR, like net revenue retention. So you add products and then you cross sell those products for those SMB customers and package those and bundle those together. I think our run rate probably will hit. I think it's possible to hit a 500 million ARR run rate by this time next year. That's what I'd say. So,
okay, last question. What was the craziest moment of the last 12 months? Like what? Just as you look back, that you're like, that happened? The freak?
There's a few that stick out, but I think it's fun. As you scale, you get to meet all sorts of interesting folks, and I think I'm pretty generally don't get into politics or anything else, but it's been very interesting learning that world across the board and meeting all sorts of different politicians on both sides of the aisle that have a lot of interest in entrepreneurs and technology. Obviously, we've seen a big push from President Trump's administration this year, like very tech forward, which I think is good. But overall, I think that's been on both sides, whether regardless, Democrats, Republicans, independents, doesn't really matter. There's been a big push. Obviously, we need to win the AI race. And I think that's like mission critical for the US. And that's been a really fun conversation to have with all sorts of local and regional and, national leaders across the board. So I think that's probably been the most interesting moment because it's a totally different world. I'm a noob, I guess, in that regard. Anything in that space. So still learning. Yeah. So good job.
Here's my takeaway from our conversation. I want to get your thoughts. Number one, if you're going to dream big. I just love the fact that you just skipped the steps you're supposed to follow. You've grown like crazy. So, and it's like, we have one life. So if you're going to dream big, go for big stuff. I think I really, really liked the idea of setting the tone with your teams, not in a douchey way, but really thinking about how you can help your teams understand either the sense of urgency or what values are really important to you. I think the other thing that you really hammered home is if you're going to get into the space, just pick one thing, go an inch wide and a mile deep. You don't need to be a mile wide and an inch deep. It's much better to be sort of that inch wide and a mile deep. And then the flywheel. I mean, it's like nothing happens and then everything all at once. It's just years of grind. And then you're, meeting with Peter Thiel.
Yep. Yeah. And I think it's so right. And that last piece, I think the flywheel effect is probably the best way to think of it. Elon, I've heard lots of entrepreneurs, not just him, talk about this. It's like, think about a company that works 40 hours a week and a company that works 60 hours a week. Compound that out over an entire year. That other company is working, 50% more, and their productivity and everything else is going to happen quicker, which adds a ton of momentum and valuation gain across the spectrum. So I think, there's speed and urgency will get you ahead of most other entrepreneurs. Most people, I actually do a bit of, it's funny, I look close on this, but I do a bit of a test with a lot of founders who say they want to sell my business, sell me their business. Whether I want to talk to them or not, I'll say, hey, can you talk Friday at 6? If they can't talk Friday at 6, I'm just okay, well, this must not be that important. Where's your priority? It's cool. I know everyone's got plans on Friday at 6 and maybe that's unfair, but it's cool. I usually tell them 6 to midnight, anytime, take your time. And they don't want to talk till Monday. I'm like, okay, well, probably not that serious. Don't really want to buy your business. So I think
that's amazing.
Matters. Even for me, now, if somebody came to me on Friday at 10 p.m. and they're like, hey, I got this thing and it's got to close by tomorrow, I would be like, drop everything to do it. Like, not because I have to, but because that's how I'm wired. So
I love it. All right. Well, go check Jesse out. Find him on LinkedIn, Twitter, all the places, Main Street, and I can't wait to have you back.
awesome. Thanks for having me, Nick.
All right. Hopefully you liked that episode. And if you've made it this far, you're either really committed or you're stuck doing yard work and you can't actually skip on your phone. So while I have you, the show is growing, but I have a favor to ask of you. Will you please help me grow the show? I want to reach more people. There's a couple things that you can do. Like and subscribe is the simplest thing. Obviously, you want to get notifications for when the next episode is coming out. But if you go the next step, will you leave me a review? 5-star on Spotify or Apple. What that does is it tells the algorithm that, oh, hey, this is a high value podcast because more people are leaving reviews for it, and it then pushes it out to more people. So that's why when people are like, will you like and subscribe and put a 5-star rating? It's not just to make themselves feel better. It's actually to get more exposure for the show. So if you do that for me, I would greatly appreciate it. And I'll see you next time.